In today's lecture, we're going to tackle one of the most important and common challenges in consolidation accounting: intra-entity inventory transfers. This might sound technical, but we're going to frame it as a story. Think of it as the shell game. How do we as accountants track profit when a company is essentially selling products to itself? We'll learn how to defer paper profits and only recognize them when a real sale is made to the outside world. Let's start with the golden rule that governs everything we're about to do. A company cannot make a profit by selling something to itself. From a consolidated viewpoint, the parent and subsidiary are a single economic entity. So any profit booked on the internal sale isn't real yet. It only becomes real when that inventory is finally sold to an outside customer. Our job as accountants is to find and eliminate this unrealized profit from the consolidated financial statements until that final sale occurs. Let's follow the journey of some inventory. In year 1, Arlington the parent sells inventory with a cost of $50,000 to its subsidiary, Zirkin, for a marked up price of $80,000. On their separate internal books, Arlington records a sale and a handsome gross profit of $30,000. Meanwhile, Zirkin records the inventory on its books at its new cost of $80,000. But has the consolidated entity, the single company, actually earned anything yet? The answer is no. The inventory has simply moved from one of our warehouses to another. That $30,000 profit isn't real yet. Our first step on the consolidation worksheet is entry TI. The TI stands for transfer of inventory. This one is simple. We just reverse the internal sale to make it disappear. We debit sales and credit cost of goods sold for the full transfer price of $80,000. This entry completely removes the phantom sale and purchase from our consolidated income statement, as if the transaction between the two companies never happened. But we're not done. Entry TI fixed the income statement, but Zirkin's inventory is still on the consolidated balance sheet at the inflated $80,000 price. We need to correct this. We use entry G to defer the gross profit. We credit inventory to reduce its value by the $30,000 of unrealized profit, bringing it back down to its original cost of $50,000. The debit goes to cost of goods sold. Increasing cost of goods sold effectively removes that $30,000 of unrealized profit from our consolidated net income for year 1. We are deferring it to a future year. Now we move to year 2. Zirkin finally sells the inventory to a real outside customer. This is the moment. The profit we deferred last year is now officially earned by the consolidated company. So our accounting task is to make sure we recognize that $30,000 profit in the correct period, year 2. We do this with the entry star G. The star simply tells us that this entry relates to a prior year's activity. The $30,000 profit we deferred last year is now sitting in the seller's beginning retained earnings, since all income accounts were closed out. So we debit retained earnings to pull that profit out. We then credit cost of goods sold. Reducing an expense increases net income. This entry correctly recognizes the $30,000 profit in year 2, the year it was actually earned by the consolidated entity.